If you think turnkey is the safe option and fixer-uppers are where people are going to lose money, you may be setting yourself up for the wrong decision. Hey, do me a favor, like the video, subscribe to the channel, hit that notification bell so you don't miss practical real estate training for serious operators. If you're new to the channel, I'm Bud Evans. I'm a United States Air Force veteran, former police officer. I also served as the mayor of a great little town in New Jersey. Today, I'm an active real estate investor focused on single-family and small multifamily properties. I mentor veterans and first responders who want to build real estate portfolios, and I founded a low-cost property management company built by investors for investors. Let's get into it. Most investors walk into this decision with a bad assumption. They believe turnkey equals safe. They believe fixer-uppers equals risk. That's the baseline. And on the surface, it kind of makes sense. Turnkey looks clean. The property is renovated. The tenant is in place. Rent is already coming in. There's no construction. There's no chaos. There's no unknowns. Fixer-upper looks the opposite. There's construction. There are contractors to deal with. There are permits to be pulled. There are delays that are going to happen, and sometimes there are budget overruns. So what do most people do? They default to turnkey because it feels like they're in control. But here's the problem. The feeling is false. Turnkey is not safer. It's just easier for people to understand. And sometimes that misunderstanding is where investors are going to lose some ground. When you buy turnkey, you are really stepping into a complicated deal where all the value has already been extracted. There's no way to force appreciation. Someone else bought it, someone else managed the renovation, and someone else took all the risk. And now you're buying the finished product at a retail price. That is going to create three immediate problems. First, you're going to have limited equity on day one. You're going to have to bring 20% to 30% to the table. Second, your margins are going to be really tight. Third, your upside is really minimal. You're buying convenience, and convenience always comes at a cost. Now, here's where the conflict starts to show up in real life. New investors buy turnkey thinking that they eliminated the risk, but what they actually did was eliminate all the control. You don't control how the renovation was done. You don't control what corners were cut, and you don't control whether or not the rent actually is sustainable. And if something was done wrong, well, you know on the problem. I've seen way too many times where cheap materials are hidden behind good paint, or inflated rent numbers just don't hold, or deferred maintenance is buried under some cosmetic upgrades. On paper, the deal looks solid, but like one of my clients who had a tankless water heater, it turned into a mess. In reality, this is already fragile. Now let's flip the perspective. Fixer-uppers scare people for a reason, and they should, because they expose your weaknesses as an operator. You're dealing with unknown costs, contractor reliability issues, timeline management, capital reserves, execution discipline, and sometimes you don't have structure, and if you don't have structure, you're going to lose money. This is where most investors fail. Not because fixer-uppers are bad deals, but because they approach them casually. They underestimate the process. They treat it like a side hustle instead of an operation. And that's where things usually go sideways. Your budget runs over, your timelines slip, or your cash runs out, and then your stress just goes way up. And now the deal that was supposed to create wealth becomes a liability. So both strategies will fail, but they fail for different reasons. Turnkey will fail because investors expect too much return from a low control asset. Fixer-uppers fail because investors underestimate the level of execution that's actually required. And that's your real conflict. It's the mismatch. People don't fail because their strategy is wrong. They fail because the strategy doesn't match their capacity. So stop asking which strategy is better. And let's ask the right question. Which strategy fits your current situation? And that will change everything. Now you're making good decisions based on reality, not emotion. All right, quick pause here. If you are a veteran and you're trying to figure out how to actually apply this to your situation, this is exactly what we work through inside the War Room with David BRRRR. Real deals, real numbers, real execution. If you need help mapping out your first move, that's where you start. You need one-off coaching, reach out to me. The link is in the description. All right, let's keep going. Here's how you make the decision the right way. I want you to evaluate three things: time, skill, and control. If you're working full-time on a 9 to 5, but they turn into 9 to 12s, right? Limited bandwidth, limited experience, and you need stability, turnkey might be your answer, but you need to go in with the right expectations, okay? You're not buying a high return deal here. You're buying a stabilized asset. There's going to be a long-term benefit to that. But this means that you have to underwrite conservatively. You don't trust listed rents. You have to verify them. Don't assume low expenses You really have to apply realistic ratios here. And don't skip the inspections. Go deeper. Your margin for error in a turnkey is really, really thin. Now, on the other side, if you're looking to build equity and really scale your portfolio and increase the control over your deals, yeah, a BRRRR property or fixer-upper might be the better path, but only if you operate correctly. And this is where your structure really matters. You can't guess on rehab costs. You have to build a detailed scope of work. You have to have a real good pay schedule, line by line, system by system, material by material. It's all got to be spelled out in that scope of work. And then you don't hire the first contractor. You get multiple bids. You compare them. You verify the references. You walk their previous jobs. You don't run tight on capital. You build contingency reserves, minimum 10 to 20% on your expected rehab, because something, not if, when they go wrong, and they will go wrong. That's not a guess. That's reality. You don't let timelines drift. You got to manage the project. You have to do minimum weekly check-ins, define your milestones, have clear expectations. This, guys, is not passive. This is operations. Now, here's where your background actually gets you an advantage. You are structured. You deal with systems. Your execution is top-notch. Most people struggle through that, right? Civilians don't understand it. You don't struggle with that. That's why the BRRRR strategy, when it's done right, will help you create that leverage, because you're forcing that appreciation and you're not waiting on the market. You're creating value. So let me make this real for you. Here's a turnkey example. You buy a property for $200,000. Okay. Your rent is $1,800. Everything looks clean, and after expenses, you might clear $200 to $300 a month. And that's fine, but it's limited because there's no major upside here, right? Now, compare that to a BRRRR strategy property or a fixer-upper, where you buy it at $140,000, you put in $40,000, your all-in cost is about $180,000, and after rehab, it appraises for $230,000. Well, you just created $50,000 in equity. And that's really the difference here. That's control. And if you can pull your capital back out on top of that, that's fantastic. But only if you execute it correctly do you get those advantages. And this is where most people get it wrong. They want the upside of a fixer-upper with the ease of a turnkey. It doesn't exist. You don't get both. You either accept lower returns for simplicity, or you accept operational complexity for higher returns. And that's really the trade-off here. There's no way around it. And if you ignore that trade-off, you're going to pay for it, usually in lost time, lost money, or worse, both. So let's close this out with a checklist that you can actually use. Decide based on capacity, not emotion. Understand, turnkey means paying retail for convenience. Verify every number on a turnkey deal independently. Don't take somebody else's word for it. Expect those thinner margins with your turnkey property. Recognize fixer-uppers create value through your execution process. You have to build a detailed scope of work before you buy the rehab. Get multiple contractor bids and verify their work. I would suggest at least 2 to 3 when you're first starting. Always include a contingency reserve in every budget. Actually manage your timelines and your project execution. Guys, if they're not doing it on time, you have to hold them accountable. Choose the strategy that's going to align with your time, your skill, and your control level. Both strategies do work, but neither forgives poor execution. Hey, if this helped you, do me a favor, like the video, subscribe to the channel, and hit that notification bell. Thanks for watching. I'm Bud Evans. Aim high, execute fast. I'll see you on the next one.